Every transaction you make, every dollar you earn, every payment you send flows through a system controlled by entities most people have never heard of. You swipe your card at the grocery store. The payment routes through Visa or MasterCard. Your bank processes it through the Federal Reserve. International transfers move via SWIFT. Currency exchange happens through foreign exchange markets dominated by a handful of massive institutions. But who actually owns these systems? Who decides the rules? Who profits from every single transaction on Earth? The answer will shock you because when you follow the money, when you trace the ownership structures, when you map the decision-making power, you discover something disturbing. The world's financial system isn't controlled by governments. It isn't managed by elected officials accountable to voters. It's owned and operated by a network of private institutions that most people couldn't name if their lives depended on it. Three companies process 95% of all electronic payments globally. Four banks control 40% of all derivatives trading. Six institutions manage 70% of global foreign exchange. And at the very top, one organization coordinates monetary policy for every major economy on the planet. This isn't conspiracy theory, this is corporate structure, ownership data, and documented control mechanisms that operate in plain sight. By the end of this investigation, you'll understand exactly who controls the flow of money around the world, how they built this system, and why every financial transaction you make generates profit for the same small group of entities. Because understanding who controls money means understanding who controls everything. Let me start with something simple. Every time you use a credit or debit card, you're paying a fee, not just to your bank, but to the payment processor. In the United States, that's almost certainly Visa, MasterCard, or American Express. These three companies process over 95% of all card transactions in America. Globally, Visa and MasterCard together handle more than 80% of all electronic payments outside of China. But here's what most people don't realize. Visa and MasterCard aren't banks. They don't lend money, they don't take deposits, they're networks. Digital toll roads. Every time someone uses a Visa card, Visa collects a fee. Every time someone uses a MasterCard, MasterCard gets paid. They've inserted themselves between every buyer and seller, collecting a percentage of virtually every transaction in the modern economy. The fee seems small, maybe 2 to 3% per transaction. But when you're processing trillions of dollars annually, small percentages become enormous profits. Visa's revenue in 2023 exceeded $32 billion. MasterCard generated over $22 billion. These aren't banks producing value through lending or investment. They're gatekeepers extracting rent from the payment system itself. And here's the critical point. You can't avoid them. Try to pay for something online without a Visa, MasterCard, or American Express card. Try to book a hotel, rent a car, buy airline tickets. The entire modern economy is built around their networks. They've created a system where participation is mandatory and alternatives are systematically excluded. But payment processors are just the first layer. Behind them sits something even more powerful, the banking system itself. And when you examine who actually controls banking, the picture becomes more concentrated, more centralized than most people could imagine. Let's look at the United States first. The American banking system appears diverse, thousands of banks across the country, but appearances deceive. The top four banks, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup, control over 40% of all banking assets in the United States. That's nearly half of all the money in the American banking system controlled by just four institutions. But concentration is even more extreme in specific markets. In derivatives trading, the business of buying and selling financial contracts, the top five banks control over 95% of the market. J.P. Morgan Chase alone handles more than 60% of all derivatives in the United States. We're not talking about a competitive market. We're talking about oligopoly so complete that it approaches monopoly. The same pattern repeats globally. In foreign exchange, the business of converting one currency to another, 6 banks control approximately 70% of the global market. JP Morgan Chase, UBS, Deutsche Bank, Citigroup, HSBC, and Barclays. These 6 institutions determine exchange rates for virtually every international transaction on Earth. When you travel abroad and exchange dollars for euros, when companies import goods from other countries, when governments conduct international trade, these 6 banks are collecting fees and influencing the rates. But even these massive banks don't operate independently. They're connected through a web of shared ownership, interlocking directorships, and coordinated policies that make them function more like divisions of a single entity than competing businesses. Here's where it gets really interesting. Who owns these banks? The largest shareholders of JP Morgan Chase are BlackRock, Vanguard Group, and State Street Corporation. The largest shareholders of Bank of America are BlackRock, Vanguard, and State Street. Wells Fargo, Citigroup, same pattern. BlackRock, Vanguard, and State Street are the top shareholders. These 3 asset management companies, BlackRock, Vanguard, and State Street, don't just own banks. They own everything. They're the largest shareholders in Visa and MasterCard. They own major stakes in every company in the S&P 500. They control over $20 trillion in assets. That's more than the GDP of the United States. But here's what makes this truly remarkable. BlackRock, Vanguard, and State Street don't compete with each other. They coordinate. They vote their shares in the same direction. They support the same policies. They operate more like a single entity with 3 different names than like competing firms. And who owns BlackRock, Vanguard, and State Street? This is where the ownership structure becomes deliberately opaque. Vanguard claims to be owned by its funds, which are owned by their investors. But the investors are largely institutional, pension funds, endowments, and other asset managers. BlackRock is publicly traded, but its largest shareholders are Vanguard and State Street. State Street's largest shareholders are BlackRock and Vanguard. It's circular ownership, a web of cross-ownership so complex that determining ultimate control becomes nearly impossible. And that's by design. The system is structured to obscure who actually makes the decisions while concentrating effective control in the hands of a small group of managers who operate these firms. But even this level of concentration isn't the top of the pyramid. Above the asset managers, above the banks, above the payment processors, sits the central banking system. And this is where global monetary control becomes most visible and most coordinated. Every major economy has a central bank: the Federal Reserve in the United States, the European Central Bank in Europe, the Bank of Japan, the Bank of England, the People's Bank of China. These institutions control the money supply, set interest rates, and coordinate responses to financial crises. They have more power over the global economy than any government, any corporation, any elected official. But central banks don't operate independently either. They coordinate through international organizations that most people have never heard of. The Bank for International Settlements, headquartered in Basel, Switzerland, is called the Central Bank of Central Banks. Every major central bank participates in BIS meetings. They coordinate monetary policy, share information, and align their actions across borders. The BIS has existed since 1930. It survived World War II, the Cold War, and every major economic crisis of the past century. It operates with diplomatic immunity. Its communications are secret. Its decisions affect every currency, every interest rate, every economy on Earth. And it's owned by the central banks themselves, which means it's ultimately controlled by the same small group of institutions that manage monetary policy globally. This coordination isn't theoretical. During the 2008 financial crisis, central banks around the world acted in concert. Interest rate cuts were synchronized. Bailout programs were coordinated. The response was global and instantaneous because the coordination mechanisms were already in place. The same thing happened during the COVID pandemic. Central banks worldwide printed money simultaneously. The coordination was so precise that it appeared choreographed. Because it was choreographed, through institutions like the BIS that operate outside public view and beyond democratic accountability. Now you're beginning to see the structure. Payment processors extract fees from every transaction. Banks control lending and investment. Asset managers own the banks and most major corporations. Central banks control the money supply and interest rates. And international organizations coordinate central bank policies globally. But we haven't reached the top yet. Because behind all of these institutions, behind all of this coordination, behind all of this control, there's something even more fundamental. The system that determines what counts as money in the first place. Since 1971, money has been whatever central banks say it is. Before that year, currencies were backed by gold. Governments couldn't print unlimited amounts because they needed gold reserves to back their currency. But in 1971, President Nixon closed the gold window. The dollar became pure fiat currency, backed by nothing except the promise that people would accept it. Every other currency followed. The pound, the euro, the yen all became fiat currencies backed only by government decree and public confidence. This created something unprecedented in human history. Money that could be created infinitely by institutions that faced no physical constraints on production. But who controls this system? Who decides how much money exists? The answer reveals the ultimate layer of monetary control, and it's more centralized than anything we've discussed so far. The dollar is the world's reserve currency. Approximately 60% of global foreign exchange reserves are held in dollars. About 40% of international transactions are conducted in dollars. Oil, gold, wheat, soybeans, virtually every major commodity is priced in dollars. This means the institution that controls dollar creation effectively controls global money supply. That institution is the Federal Reserve. But the Federal Reserve isn't what most people think it is. It's not a government agency. It's a private corporation owned by member banks. The Federal Reserve Bank of New York, which conducts most Fed operations, is owned by the largest banks in its district. J.P. Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley. The banks that benefit from Fed policy literally own the institution that makes that policy. The structure is brilliant in its simplicity. Private banks own the Fed. The Fed creates money and lends it to those same banks. The banks profit from the spread between what they pay the Fed and what they charge borrowers. It's a system designed to generate profits for bank owners while socializing losses to taxpayers when things go wrong. But the Fed doesn't operate in isolation. It coordinates with central banks worldwide through institutions we've already discussed. The Bank for International Settlements, the International Monetary Fund, the World Bank. These organizations synchronize monetary policy globally, ensuring that money creation happens in coordination rather than competition. This coordination is visible in every major financial crisis. When Lehman Brothers collapsed in 2008, central banks worldwide opened currency swap lines within hours. Dollars flooded into European banks, Asian banks, banks across the globe. The response was coordinated because the infrastructure for coordination already existed. The same pattern repeated during COVID. The Fed created over $4 trillion in 2020 alone. But European banks, Japanese banks, banks worldwide also received dollar funding through Fed programs. The dollar creation wasn't just American, it was global, because the system is designed to function globally under coordinated control. Now let's trace this back to you. Every financial transaction you make connects to this system. You deposit money in a bank owned by BlackRock, Vanguard, and State Street. You use a credit card processed by Visa or MasterCard, also owned by the same asset managers. You take out a loan at rates influenced by Federal Reserve policy coordinated with central banks worldwide. The money you earn is created by the Fed and distributed through banks that own the Fed. The investments in your retirement account are managed by asset managers who own the banks and the Fed. The entire system is circular, with the same entities controlling every layer while appearing to operate independently. But there's another dimension to this control that makes it even more comprehensive. Information. Financial markets don't just move money, they process information. And the institutions that control information flow control market behavior itself. Bloomberg terminals sit on trading desks in every major financial institution worldwide. Reuters provides news and data to banks, asset managers, central banks. These information systems aren't just reporting on markets. They're shaping market behavior by determining what information traders see and when they see it. Bloomberg LP is privately held by Michael Bloomberg and his employees. Thomson Reuters is publicly traded but controlled by institutional investors, including BlackRock, Vanguard, and State Street. The same entities that own the banks own the information systems that guide bank decision-making. This creates information asymmetry on a global scale. The institutions that control money creation also control information flow. They know what's happening before anyone else because they own the systems that process and distribute information. They can position themselves advantageously before information reaches public markets. High-frequency trading provides another example. Firms like Citadel, Virtu Financial, and Jane Street Capital use computer algorithms to trade millions of times per second. They profit from tiny price differences that exist for milliseconds. These firms handle approximately 50% of all stock trading volume in the United States. But high-frequency trading requires infrastructure. Fiber optic cables, data centers, direct market access. This infrastructure is provided by exchanges like the New York Stock Exchange and NASDAQ. The NYSE is owned by Intercontinental Exchange. NASDAQ is publicly traded. The largest shareholders of both companies are BlackRock, Vanguard, and State Street. The pattern repeats everywhere. The entities that own the infrastructure also own the institutions that use the infrastructure. It's vertical integration on a scale that encompasses the entire global financial system. Derivatives markets provide perhaps the clearest example of this control. Derivatives are contracts that derive their value from underlying assets: stocks, bonds, currencies, commodities, interest rates. The derivatives market is enormous, with notional value exceeding $600 trillion. That's more than 7 times global GDP. But derivatives trading is concentrated in the same handful of banks we've discussed. J.P. Morgan Chase, Goldman Sachs, Citigroup, Bank of America. Morgan Stanley control over 90% of derivatives trading in the United States. These banks aren't just intermediaries, they're counterparties to most derivatives contracts. They profit whether their clients make money or lose money. The derivatives market allows these banks to hedge virtually any risk while transferring that risk to other market participants. They can profit from volatility while their clients bear the losses. It's a system designed to concentrate profits while distributing risks. And who regulates this system? The same institutions that participate in it. Banking regulators are staffed by former bank executives who return to banking after their government service. The revolving door between Wall Street and Washington ensures that regulations are written by the industry being regulated. Federal Reserve governors typically come from major banks or asset management firms. Treasury secretaries regularly move between government service and Wall Street. The Securities and Exchange Commission is led by officials with extensive financial industry experience. Regulatory capture isn't a bug in the system, it's a feature. This regulatory structure ensures that the system perpetuates itself regardless of political changes. Democratic administrations and Republican administrations may differ on many policies, but they consistently maintain the same financial system architecture. The same banks remain too big to fail. The same asset managers continue growing. The same central banks coordinate globally. International trade provides another layer of this control. When countries trade with each other, they need a common settlement system. That system is SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT processes messages between banks, enabling international transfers and trade financing. SWIFT is based in Belgium but dominated by American and European banks. It operates under Western legal jurisdiction and can exclude countries from the global financial system by cutting their access to SWIFT networks. This has happened to Iran, Russia, and other countries that challenge Western financial hegemony. But SWIFT exclusion doesn't just affect the targeted countries, it affects any institution that wants to do business with those countries. Banks worldwide must choose between access to Western markets or business with sanctioned nations. The choice is obvious, and it demonstrates how financial infrastructure creates geopolitical control. China has developed alternatives like the cross-border interbank payment system, but these systems remain much smaller than SWIFT. The network effects of the existing system make competition extremely difficult. Most international banks need SWIFT access to serve their clients, which means they must comply with Western sanctions regardless of their own country's policies. This financial architecture extends beyond banking into every aspect of the modern economy. Pension funds, insurance companies, hedge funds, private equity firms all operate within the same interconnected system. They invest through the same custodian banks, trade on the same exchanges, use the same settlement systems. The result is a global financial system that appears diverse and competitive, but functions as an integrated network controlled by a small number of institutions. These institutions profit from every layer of the system while bearing minimal risk. Because losses are socialized through government bailouts funded by taxpayers. Understanding this system changes how you see every financial decision you make. Your bank account, your credit cards, your investments, your mortgage all connect to the same network of control. Every transaction you make generates profits for the same entities while providing them with data about your financial behavior. The system isn't breaking down or failing. It's working exactly as designed, concentrating wealth, controlling information, coordinating globally, and perpetuating itself across political and economic cycles. The question isn't whether this system will continue. The question is whether enough people will understand how it works to demand something different. The scope of this financial control extends far beyond what most people imagine when they think about banking or money. Every mortgage you sign, every insurance policy you purchase, every retirement contribution you make feeds into this same centralized system. But there's another layer that makes this control even more comprehensive and harder to escape. Real estate, the largest store of wealth for most families, operates through the same controlled networks. When you buy a house, you need a mortgage. That mortgage is originated by a bank, but it doesn't stay there. Within weeks, your mortgage is packaged with thousands of others and sold to government-sponsored enterprises like Fannie Mae and Freddie Mac, or to private investors. Who are those private investors? The same asset management giants we've discussed. BlackRock is the largest investor in mortgage-backed securities. Vanguard and State Street hold enormous positions in real estate investment trusts. The companies that own the banks also own the mortgages those banks originate. They profit from origination fees, servicing fees, and investment returns on the same loans. But it goes deeper. BlackRock has become one of the largest single-family home buyers in America. They purchase homes directly, converting owner-occupied housing into rental properties. This isn't just investment strategy. It's market manipulation on a massive scale. When the entity that helps set mortgage rates also buys homes directly, they can influence both sides of the housing market simultaneously. The rental market follows the same pattern. Large institutional investors now own millions of single-family rental homes. Companies like Invitation Homes, American Homes 4 Rent, and Progress Residential have consolidated what used to be a fragmented market of individual landlords into a controlled oligopoly. And who owns these companies? The same institutional investors that own everything else. This means housing, whether you buy or rent, generates profits for the same network of entities. Your monthly housing payment, typically your largest expense, flows to institutions that coordinate their policies across multiple markets. They can simultaneously influence mortgage rates, home prices, and rental rates because they participate in all three markets. Insurance represents another critical control point that most people never consider. Every car insurance payment, health insurance premium, life insurance policy connects to the same system. Insurance companies collect premiums and invest them in financial markets. Those investments are managed by the same asset managers and held in accounts at the same custodian banks. But insurance serves another function in this system. It socializes risk while privatizing profits. When natural disasters strike, when markets crash, when pandemics disrupt commerce, insurance companies pay claims. But those losses are ultimately absorbed by policyholders through higher premiums and by taxpayers through government backstops. The insurance industry is heavily regulated, but those regulations are written to protect the industry rather than consumers. Insurance companies must maintain reserves, but those reserves are invested in markets controlled by the same entities that own the insurance companies. It's another circular system that concentrates wealth while distributing risk. Retirement savings provide perhaps the clearest example of how this system captures individual wealth. Your 401k contributions are invested in mutual funds managed by companies like BlackRock, Vanguard, and State Street. These companies use your money to buy shares in corporations, then vote those shares to elect corporate boards and approve executive compensation. This means your retirement savings are used to concentrate corporate control in the hands of asset managers who may not share your interests. They vote to approve CEO pay packages that you might oppose. They support corporate policies that might harm your community. They use your money to increase their own power while claiming to act in your best interests. The scale of this retirement wealth capture is staggering. Americans have over $30 trillion in retirement accounts. That money is managed by institutions that use it to control corporate America while charging management fees that compound over decades. Your retirement security depends on the same system that extracts wealth from your working years. Student loans represent another dimension of this control. The federal student loan program creates debt that cannot be discharged in bankruptcy. Students borrow money created by the Federal Reserve, guaranteed by taxpayers, to attend universities that increase tuition faster than inflation, because they know the loans will be approved regardless of ability to repay. This debt follows graduates for decades, limiting their ability to buy homes, start businesses, or build wealth. The debt payments flow to the same financial institutions that service other types of loans. It's a system that converts young people's future earning potential into immediate profits for the financial sector while creating dependency that lasts for decades. Healthcare financing operates through similar mechanisms. Health insurance premiums are invested by insurance companies in the same financial markets. Medical debt, when it occurs, is packaged and sold to debt collectors who are often owned by private equity firms funded by the same institutional investors. Hospital systems are increasingly owned by these same private equity firms. This means healthcare costs, which can bankrupt families, generate profits for the same network of financial institutions. They profit from insurance premiums, medical debt collection, and hospital ownership, while individuals bear the risk of medical expenses that can exceed their lifetime earnings. The technology sector, which appears innovative and disruptive, operates within this same controlled framework. Major technology companies are funded by venture capital firms and private equity firms that are themselves funded by institutional investors. When these companies go public, their shares are purchased by the same asset managers that own everything else. Amazon, Google, Apple, Microsoft all have BlackRock, Vanguard, and State Street as major shareholders. These technology companies collect data about your behavior, purchases, preferences, and relationships. That data is used to influence your financial decisions, directing you toward products and services that generate profits for the same network of institutions. Social media platforms, search engines, and online marketplaces aren't just convenient services. They're data collection systems that help financial institutions understand and influence consumer behavior. The advertising revenue that funds these platforms comes from companies owned by the same institutional investors, creating another circular flow of wealth within the controlled system. Commodity markets provide another layer of this control that affects everyone through food and energy prices. Agricultural commodities, oil, natural gas, metals, all trade on exchanges owned by companies with the same institutional shareholders. The prices of these commodities are determined not just by supply and demand, but by financial speculation from institutions that can move markets through sheer size. When oil prices spike or food costs increase, consumers bear the burden while financial institutions profit from the volatility. They can take positions on both sides of commodity markets, profiting whether prices rise or fall, while ordinary people face higher costs for necessities. The currency markets themselves represent the ultimate expression of this control. Every time you travel internationally, every time you buy imported goods, every time companies engage in international trade, they participate in foreign exchange markets dominated by the same 6 banks we discussed earlier. These banks don't just facilitate currency exchange. They actively trade currencies for their own accounts, potentially against the interests of their clients. They can profit from currency volatility while their clients bear the costs of exchange rate fluctuations. The banks have perfect information about client flows, giving them enormous advantages in currency trading. Central bank digital currencies represent the next evolution of this system. Governments worldwide are developing digital versions of their currencies that would give central banks direct control over every transaction. Unlike cash, which can change hands without government knowledge, digital currencies create permanent records of every economic activity. This technology would allow central banks to monitor spending in real time, to block transactions they disapprove of, and to implement negative interest rates by making money disappear from accounts automatically. It's the ultimate tool for financial control, and it's being developed by the same institutions that already control the existing system. The environmental, social, and governance movement in investing represents another mechanism of control disguised as social responsibility. ESG investing directs capital toward companies that meet certain environmental and social criteria determined by the same asset managers that control the investments. This allows asset managers to influence corporate behavior not through regulation or democratic processes, but through capital allocation. They can reward companies that adopt their preferred policies and punish those that don't by directing investment flows. It's governance through finance rather than through elected officials accountable to voters. The pattern extends to every aspect of the modern economy because money touches everything. Entertainment companies, news organizations, social media platforms all depend on financing from the same institutional investors. This creates subtle but powerful incentives to avoid topics or perspectives that might threaten the financial system's stability. Media companies owned by institutional investors are unlikely to investigate those same investors critically. Entertainment content that questions the fundamental structure of the financial system gets limited distribution. Social media algorithms controlled by companies owned by asset managers can limit the reach of information that threatens financial stability. 3 companies control your payments. 6 banks dominate global currency exchange. 3 asset managers own everything else. And above them all, central banks coordinate monetary policy through secretive international organizations that operate beyond democratic accountability. This isn't the free market system you were taught about in school. It's a carefully constructed architecture of control that extracts wealth from every transaction while concentrating power in the hands of institutions most people can't even name. Now you know who really controls the world's money.